I love home equity lines of credit. Guys, stick around today because I'm going to teach you the very best and we'll recap the very worst of home equity lines of credit as a debt weapon. Coming up next. All right, guys, here I am at the offices in Denver. Matthew Pillmore, president of a company known as VIP Financial Education, where we teach people how to go further, faster financially. And we do it through the 3 C's of proper banking and borrowing. By that I mean credit, capital, and cash flow maximization. As promised, I'm coming at you today. I taught you last week why I hate home equity lines of credit, and today we're going to talk about why I love home equity lines of credit. Guys, you're going to hear some construction in the background. I'm out on the patio of our offices here in downtown Denver where there is constant construction and growth and progress, so the background just reminds us to keep on hustling. Now, we talk a lot about tools that we call debt weapons, and debt weapons are basically any vehicle which allows us, first and foremost, to maximize the money left over at the end of each month, known as cash flow. And home equity lines of credit come into the conversation often. Why is that? Well, there's a lot of people talking about various types of acceleration strategies, specifically mortgage acceleration, utilizing a home equity line of credit. In most cases, this is done through a refinance into a first lien home equity line of credit, where similar concept to our paycheck and rent check parking process can be implemented. There are several downsides to this, which all involve the reasons why I hate home equity lines of credit. So let's recap that first, and then we'll turn our attention to all the reasons why they're amazing. First is there is a variable interest rate. So refinancing away from a longer term fixed loan that in today's environment often comes at record low interest rates is dangerous. Why put yourself into a variable rate through a home equity line of credit, either attached to some sort of index like the LIBOR or Prime, whereby if something changes and inflation drives interest rates up, economically, none of us have any real control. Therefore, it could end up causing a lot of damage with respect to our outflow every month and our cash flow. Therefore, I don't like putting the bulk of an existing mortgage balance on a variable home equity line of credit. Number 2, the banks have the right and often will freeze home equity lines of credit in a volatile economic climate. So keep in mind that in the last downturn, all of my home equity lines of credit debt weapons were frozen. That means the bank essentially prevents me from drawing any of the previously available dollars off of that line. In fact, I just have to repay it as agreed. Usually it does not force any type of eviction or foreclosure. It just simply means that the payment has to be made every month and you can't get access to any more of the money. What happens if you're paycheck and rent check parking in that process and you've deposited 100% of what you bring in into the month against that balance, thinking you're doing things the right way, and suddenly you can't get access to it anymore? What if that was your investment vehicle? What if that was your primary source of liquidity? That is a very dangerous position to be in as well. So freezing home equity lines of credit is common. Now, I want to address why they might freeze that, because 100% of my non-mortgage related or unsecured debt weapons remained open during the last downturn. 100% of my secured home equity lines of credit were frozen. Not one of my unsecured were. So when we talk about secured and unsecured, the difference is collateral. And when you're securing a home equity line of credit against the collateral of an asset that is supposedly decreasing in value, when you see on a national level property values slipping and coming back down, the banks have to protect themselves from the potential increased risk of defaults, which therefore means they're going to freeze these lines of credit. In the unsecured environment, where I'm the collateral and it's based on my current credit worthiness, it's unlikely that they will freeze if I stay the same in the same condition as a borrower. If my borrowing strength is as good or better than when I first got the loan, when the lending institutions do soft inquiries on my credit and are able to confirm that that's the case, they have no reason to freeze that account. So that's why you'll see secured accounts frozen and not see unsecured accounts frozen in the same economic environment. The last reason that I dislike home equity lines of credit is that they can be very difficult to get on non-owner occupied properties. In today's lending environment, things are a little looser. It reminds us of the mid-2000s. But in tougher economic conditions, the banks constrict their liquidity, and it's very unlikely that a borrower will access home equity lines of credit on investment properties. So those are all the downsides. Now let's talk quickly about why I love home equity lines of credit. First and foremost, they are 100% liquid. It's same as cash. If you've used a home equity line of credit in the past, you know you can simply write a check. It's money in the bank. You can get it, put it back, get it, put it back as many times as you want to. Another reason that I love them is they are often considered eligible forms of down payment. So if I want to go out and buy real estate, I can use availability from a home equity line of credit in order to do that. So let's say, for instance, I have a $50,000 home equity line of credit availability, and I want to buy a $200,000 investment property. And let's say I need 20% down for that to happen. I could borrow $40,000 from the $50,000 I have available, leaving $10,000 for vacancies and fix-up costs or general maintenance of that property. And I have now no money out of my own pocket in order to acquire a new asset. That produces, in both the short and long-term rental game, an infinite return on investment. That is really, really powerful. But now let's say a second property for $200,000 appears. I don't have another $40,000 available. Well, what happens if we were able to transfer that money away to another form of a debt weapon? That home equity line of credit would be available for use once again. Really, really powerful. Another reason I love home equity lines of credit is that under today's current economic climate, there are really low interest rates associated. When coupling that with techniques like paycheck and rent check parking, we can avoid substantial amounts of long-term interest costs on these tools. So they're very inexpensive. In fact, even getting a home equity line of credit can be relatively inexpensive compared to things like cash out refinances. When you go and you refinance a property and you take a home equity loan, which is an amortized product, versus a home equity line of credit, which is a revolving product, it costs substantially more money to get those. So if you can get a HELOC and spend hundreds of dollars versus refinancing and spending thousands of dollars, that obviously is really appealing. There are also potential tax benefits by using home equity lines of credit. That is just a cherry on the top. And finally, you can often get high loan to values with these primary residence home equity lines of credit. High loan to values can even exceed 80% combined between your first and potentially your second lien home equity line of credit. So I've seen banks in strong economic climates lend out all the way to 100% combined loan to value, but it's not uncommon at all to see at least 80% in combined loan to value for your lending potential of availability on these lines. The other reason that's good is because in high loan to value markets, that often means you can get access to quite a bit of money. If your home equity line of credit is $100,000 or even more, that's a great start with respect to getting access to up to $250,000 worth of debt weapons every single year. So the best case scenario and the conclusion of this video is that having a combination of all types of debt weapons and having a wide collection of each type is really important in order to accelerate the financial priorities that you and your family have. We want to be able to use each tool in its appropriate setting, but also simultaneously protect ourselves from the potential risks that occur in any economic environment. So this is a very deliberate balance between aggression and safety. It is not seeing how fast we can go and we throw caution to the wind and we just simply wing it and hope for the best. We are constantly putting ourselves into a safer yet more accelerated position. Hopefully this helps you guys to some extent. If you want to learn more about home equity lines of credit and other debt weapons, make sure that you click the link in the description below to register for your one free coaching session that we provide all of our viewers here on YouTube. If you haven't done so yet, I consider subscribing to the channel. We've got unbelievable content on this channel, content I've not seen on any other resource here on YouTube or any other website for that matter. So make sure that you're a participant so you can get out there and beat those banks, turn the banks against each other, and get as far as quickly as possible for the least amount of money and with the least amount of risk as you can get there. We're here to help you do it, guys. We look forward to seeing you on the next video. Thank you so much for checking this one out. Make it a great day today and take care. Thanks.